Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. Today we're going to be talking about budgeting and the concept of budgeting for business. We'll also talk about the impact of budgeting on the business. So let's go ahead and jump into that conversation. So budgeting. Budgeting, so I can get to start. Budgeting, see if I can get this thing to hide. Budgeting is really very, very important for business. The reason for that is if you don't know how much funding to allocate to business activities, you're going to have a difficult time paying the company's bills. Allocating resources through budgeting is so important for that reason. And if you underallocate, overallocate funding for certain business activities, it can cause problems in the future. And that's why budgeting is so important. Now, of course, we're going to talk about the concept of budgeting through the manufacturing company perspective because you need to understand how to budget for fixed and variable expenses. And of course, for the concept of manufacturing, we have direct materials, direct labor, factory overhead that make a product. You need to know how to budget those things. So why do we do budgeting? Why is it important to budget? What are the benefits? These are all nice words. We do budgeting for planning. We plan for the future. We do budgeting to control our spending, and we compare that to what we actually spend. Right. We use budgeting to coordinate activities across the company. We use budgeting to speak to managers throughout the organization about what's happening in our departments. We use budgeting to help employees to understand the company's goals. We also use budgeting to motivate our salespeople and our managers to establish and obtain goals. These are all great things. It sounds nice. It's not as easy as it sounds. Just like most things that we do in life, it's never as easy as it sounds. There's a lot that goes into these things, right? So, like planning, for example, most businesses plan their budget to like 12 months out. For the next 12 months, my company has a budget, okay? And I budget for consecutive 12 months in the future. What that means is we call it a rolling budget. And what that means is I already have since right now we're in, let's see, July 2022, I have budgeted from July 2022 all the way until August 2023. Now, the reason I budget that far out is I need to plan for the future, right? That's like the objective. That's why I budget for 12 consecutive months. What happens is once July 2022 finishes, I budget for August 2023. When August 2022 finishes, I'm doing the budget for September 2023. Okay, it's always 12 months in front of us. That's what's called a rolling budget. It's always 12 months out. Having that type of plan helps the business to focus on goals, right? our sales goals. That also helps me to control my expenses. Now, here's how that works. I can get a really good understanding of what my electric bill will be in July 2023 based on what happened in July 2022. Okay. I know how do I know that? I can probably guess what it will be within maybe 10%. And the reason for that is I know what my production level was like for July 2022. If I get the same production level, then I can expect to have the same amount spent for electric a year from now. That helps us to plan, right? We base a lot of our budgets on what has already happened in the past. We can project forward. We do that with sales, we do that with expenses. So these are some of the these are the benefits of budgeting. Now, anytime that there's money involved, there's an impact on human behavior. In the past, you may have heard me say, you know, finance, counting, finance is 20% book knowledge, 80% behavioral. That's true. Finance is 20% book knowledge, 80% behavioral. The thing is, everything we do when it comes to money, when it comes to finance, it's mostly behavioral driven. For example, if I know that my rent is $1,800 a month, then I plan to save that $1,800 each month and use it for rent. I'm budgeting the rent expense. $1,800 a month? Okay, make sure you set enough aside for rent. Gas bill. I expect my fuel bill to be, well, these days it's like $200 a month. Right? So I budget $200 a month for fuel. Get to and from work. I need to budget my groceries. Okay, well, it's pretty straightforward, kind of. So I'll budget, X amount of dollars a month for groceries. That's how budgeting works in your house. It's the same way for business. We know, we have an idea what we need to spend and what we need to spend it on. That's part of budgeting, right? How much money we have coming in. If you're on salary, you know how much money you got coming in every month. If you're hourly, you have an idea of what's coming in every month. Amount of hours you expect to work, times your hourly wage, gets you your expected gross income, minus taxes, gets you your expected net. You can estimate that, right? That's the whole idea behind budgeting. You're estimating what you think is going to come in, and then we estimate what we think is going to come out. That's budgeting. The human side of that is that we are motivated individuals. And we also make emotional decisions using money, right? So, did you really need to go out to eat 3 times last weekend? I'm sure you probably didn't. You could have saved money by cooking at home, right? You did. That's human behavior. You had the desire to do that, so you did that. And now you don't have as much in your account as you had anticipated because of your human behavior. The same thing that works in business. I promise you, Todd. It's a little different, but it's the same. The motivations are the same. We as humans make decisions based off of our emotions that impact our finances. Okay? The same thing's happening in business. For example, I need to set a sales budget for my company. And that's how you start with budgeting, is you start with a sales budget. And the sales budget says, I plan to sell this amount every single month. I plan to sell this amount every single year. Okay? So I need to sell $1 million worth of my inventory every single year in order for me to keep generating the same amount of desired profit. Okay? So I'll set that goal. I'll say, okay, I need to sell that much, which is X amount of inventory, right? That's my goal. That's my benchmark, my goal, right? So we set a goal. The goals need to be challenging but attainable at the same time. We know or expect that our actual performance is going to be different than our budgeted amount. Okay, what I mean by that is I set my sales goal relatively high, but it's obtainable. I might not hit that. I might not hit that sales goal every month. It might be, a little less, a little more. I know it's not going to be this exact amount. The same with the expenses, right? So I'm budgeting my utility bill, $150 a month. Sometimes it'll be a little less. Sometimes it'll be a little more, right? Depends on how much I'm running the AC during the summertime. Depends on how much lights I'm using. You know what I'm saying? So we budget. It might be a little lower, it might be a little more. As long as it's within relative range, we can explain it all. I had an extra guest in the house, so the electric bills are higher. Whatever. But these are all like motivating factors to hit your numbers, right? That's what we're saying in sales. To hit your numbers, to obtain your sales amount, to hit your budgeted expenses. It's a motivating factor, right? Oh, I'm going to hit these expenses. I'm going to hit this revenue. Absolutely. With human behavior also comes some negative, right, into the business. Some employees, this drives me absolutely nuts, by the way. When employees do this. Have any of you worked in sales? Just out of curiosity. Have any of you worked in sales at all or sold anything in the past?
Yes, sir.
Peter, tell me what kind of sales was it?
Liquors and spirits, spirits and fine wines.
Okay, cool. So, spirits and fine wines. So, Peter, as a spirits and wine salesperson, uh, have you what now when you're selling those stuff? Do you have like goals like you need to sell X number of bottles or X amount of dollars for like that week or that month or whatever? Did you have that?
So because it is a small business, we don't have goals set by the general manager, but I do have personal goals that I like to achieve every. I do it by bi-weekly periods.
Okay, cool. And so Peter, how do you track that? Like, how do you track the amount that you're selling individually or number of bottles? Like, what's your process for tracking that?
So we actually have a pretty good database through our website that we use.
Oh, cool. Very cool. Okay, so Peter, let's say you set your goal. Some employees will set that sales goal, a little low, and then they'll slave through it. But let's say Peter's sales goal was, let's say it was $10,000 in sales for the month, okay? And Peter goes, oh, I know I can hit that, and that's easy, right? I think 1,000, that's nothing. So I'll say my goal is 10,000. Makes it look great. You know what I'm saying? Hey, that number looks good on paper. then Peter slams through that sales goal. He's selling, 15, 20,000, right? And Peter knew that sales goal was really, really easy to get because I've done it before, right? It's like, okay, 10,000 a month, oh, 15, 20, we call that understating the sales goal. You knew that you could sell more than that, but yet you put that bar low enough where you can just jump on over. You know what I mean? So that drives me nuts as a manager. The reason for that is uh, it makes it difficult for me to budget my sales when my employees say that they're going to sell this amount, but then they blow it out of the water. Okay, that messes with my budget. So that drives me crazy. Why does it mess with the budget? Because let's say Peter sold 15, 20,000 dollars a month, and he said, "Oh, I'm selling 10,000 a month." He did that on purpose. But that one of the problems that can cause is the store might not have enough bottles to sell, right? Because he's selling so much. So that for as a manager, that would drive me crazy. So so that's why it's important that you set your sales goals as close to accurate as possible. You don't want to, set it too low because set it too high even because that can cause problems with respect to like inventory and other budget aspects of the budget. And the same as with expenses. Peter, does that make sense?
Yeah, that actually happens frequently where we have because we do have a couple of very competitive people on our sales team. So especially when we get a limited number of maybe say a special edition whiskey that just came out or something, we end up having to change people's orders down to something that's much more mass produced because we have so many people that they sell such a high volume already. So, the bottles are already spoken for by the time, especially me, who, yeah, I just started probably about 6 months ago. So by the time I get to it, these sharks have already gotten it.
Yeah, that's exactly right. But that's what happens, right? Salespeople. It's not just you. I mean, a lot of people who do that, and like I said earlier, it looks great on paper. That, oh yeah, I'm blowing through these goals. But when it comes to like planning for that inventory, it really messes things up. So that's why it's important that salespeople really try to keep that within range. And the same with expenses. For expenses, a lot of business owners and managers, they're like what I call pad the expenses. They pad them, they cushion them, they pad them. What that means is they'll purposely say that the expenses are going to be higher than what they actually come in at. And that's problematic. Sorry, go ahead. See?
Oh, sorry, Professor. I just had like sound issues. I don't know if it's just me, but it's hard to like understand what you're saying. I think it's I don't know what it is, but I'm gonna try to log out and log back in.
Okay, no problem. Yeah, it's a technology sometimes.
Well, sir, that actually happened the previous week. I believe it's your webcam microphone.
Right. Yeah, I can try to unplug that to see what that does as well. Well, hopefully I unplugged the right one.
Okay.
Perfect.
All right, cool. So with expenses, a lot of business owners and managers tend to pad their expenses. What that means is they're making the expenses higher than what they actually are. In their mind, they're thinking, well, if my actual expense comes in lower than my budgeted expense, my actual comes in lower than my budgeted, then I can use that extra fund to do X, Y, and Z. That's why they do that, right? They'll purposely say, "Hey, my expenses are going to be this." It'll actually come in a lot lower, and so they'll have that understanding. Oh, I can use that extra money to do X, Y, and Z. That's not how budgeting works, but that's one of the things that they do. So, Selena, is that better? The audio?
Yes, it's so much better. Thank you so much.
Great. Yep. Thank you. Other potential issues with human behavior and budgeting is sometimes if we give ourselves too much of a sales goal and we can't meet it, like, so let's say we set it too high, all right? And we know we can't meet it, or it's going to be really, really tough to meet it. And if I don't meet it, they're going to fire me. Oh, if I don't meet it, they're going to be really upset. Oh, if I don't meet the sales goal, they might X, Y, and Z. That's pressure. That's negative pressure, right? It's like nobody likes that kind of pressure. I don't like to be pressured. Okay, that's why I don't put the time limits on these exams, right? Because that gives me anxiety. And I don't like anxiety. I don't like being anxious. I don't like feeling pressure. So in the workplace, sometimes we feel pressure from our employer to meet certain goals, right? That kind of pressure can sometimes be very negative, and it can lead to unethical behaviors. Okay? Because you might be like, "Oh, what if I just adjust this sales goal and make it look like I actually made it by altering a couple of numbers?" That's unethical and probably fraudulent. Don't do that. But those kind of pressures cause us to do things like that sometimes. So that's a negative human behavior that comes from budgeting. If something like that ever happens to you in the workplace, talk to your boss about it. Talk to the owner. Talk to the manager. And if you are the owner or the manager, you need to find ways to reduce that pressure, because that will cause a lot of problems in the organization. Sometimes employees might purchase unnecessarily to meet the budget. Oh my God. Let me tell you about this one. So, number 3, the federal government is notorious for this, and that drives me nuts as a taxpayer. And it's not just the federal government, the state government does it, the local government does it. They all kind of do it, It's kind of like a practice, really, when it comes to these organizations. Some nonprofits do this. It drives me crazy. They will go out and spend to maximize the budget, so that way next year they get the same amount. So what they'll do is in September, late September, there they are. The government's out there scrambling, spending all kinds of money on these line items on the budget, so that way they could get the same amount next year. So they'll go purchase all this ridiculous stuff to spend the amount that they need to spend, so that way that doesn't get reduced for the next fiscal year. That drives me absolutely insane, number one. It should be illegal in my opinion, but it's not. Companies do that too. So, like defense contractors who work with federal monies, they do that. They'll spend to the maximum amount to make sure that they get the same amount next year. And yeah, it's not good. It's not a good practice in business, right? But they do it anyway because they don't want their budget to be reduced. It's another negative pressure. So let's talk about budgeting, like how it works in practice. This goes back to what I was saying earlier about the rolling budget. I budget for 12 consecutive months because I need to understand the trends in the revenue and expenses throughout the year. So here we are in July 2022. I already have the budget done for July 2023. And when July 2022 is done, I'll do the budget for August 2023. And then when August 2022 is done, I'll do the budget for September 2023. And the reason for that is you always want to have 12 consecutive months in front of you. We call that a rolling budget. And that helps us to understand where we are at all times. And it gives us the ability to create benchmarks. So we do that, and we do that for sales, and we do that for our expenses. But it really is a good method, budgeting, to do it for 12 consecutive months forward. So 12 consecutive months, 12 consecutive months. You always have 12 consecutive months in front of you. That's the idea behind a rolling budget. Let's talk about the different kinds of budgets and what we call the master budget. The master budget. Now, I'm going to tell you a story behind the master budget, very short story. And I'm going to explain how it works. Okay, so in business, everything starts with sales. That's why you're in business in the first place, is you're selling a product or a service. That's what business is. So we start with everything with sales in mind first. That's how you start a business, is by selling a product or a service. Even if it's a nonprofit, they're still selling a product or a service. Even if it's the government, they're providing a product or a service. So sales, revenue, sales. We start with sales. The sales budget drives all other budgets. Okay, the sales budget drives all other budgets. Now, within the sales budget, I am budgeting the amount of revenue I expect to collect, and I'm budgeting the amount of products I expect to sell. All right. Now, when I've budgeted that, the number of products I expect to sell, that tells me how many products I need to produce. Right? If I expect to sell 10,000 units, and I expect to end the previous accounting period with 5,000 units, that tells me I need to produce 5,000 more to meet that 10,000 sales goal. And if I know I need to produce 5,000 units in order to sell 10,000 units during the accounting period, that tells me I need to purchase direct materials to create the 5,000 units. I need to budget direct labor to produce the 5,000 units. And I need to allocate factory overhead to produce those 5,000 units. And once I understand how much I need to budget for direct materials, direct labor, factory overhead, it tells me how much cash I need to make all those things possible, right? The sales budget also tells me about my general selling administrative expenses that will be a result from the sales of the 10,000 units. And it also tells me how much money I should have set aside for capital expenditures. Capital expenditures are things like investing in property, plant, and equipment, new machinery, new factory, new production line. These are all capital expenditures. all of these budgets combined make up what we call the master budget. So think of all of these individual things as these are all individual budgets: a sales budget, a production budget, a direct materials budget, a direct labor budget, a factory overhead budget, a cash budget, a selling and general administrative expense budget, and a capital expenditure budget. All of these are individual budgets, but when combined, they make up the master budget. So, real quickly, let me tell you how all this works in real life, because I've done this for many, many years. As a financial controller of a very large hotel in New York State, one of the primary responsibilities of the financial controller is to control the budgeting process. Now, in a hotel, you typically have a couple of departments. You have the sales department, the rooms division, and within the rooms division, you usually have front of house and back of house. You have the food and beverage division. Well, in the food and beverage, you usually have beverage, food, restaurant, etc., and room service. And you also have an engineering department, and within the engineering, they take care of maintenance, right? And yeah, so and you usually, and then you have like the support offices. Support offices include human resources, accounting, payroll, and sometimes administrative departments. And that makes up all the departments within a hotel, typically, for a full service hotel. So you have all those different departments. So the way it works is, the way I did it, the way I controlled the budgeting process, is I had an idea from our sales department. They would tell me, this is what we expect to have coming in next year. So, okay. So I would factor out, this much money is going to be collected from weddings. This much is going to be collected from existing contracts we have for rooms. This is what we're going to have for, and then I can estimate the rest of it, right? Oh, we're going to have a couple of conventions in town, etc. So I can estimate the rest of the revenue we'll generate from the hotel, from the rooms. And then I can figure out a little bit from the restaurant based off of previous year's sales. And so I have a good idea of what the sales are going to be. And then what I'll do is I create a separate income statement for each department. And I'll give those income statements to each department manager. I'll say, okay, here's the amount of revenue that we're going to allocate to your department. Now, using this number, tell me what you expect to spend and on what. And so they'll write out, like for example, the engineering department will say, I expect to spend, $8,000 in paint, $10,000 in tools, $2,000 in wire, et cetera, et cetera. They budgeted it out for their department. And then they'll tell me how much labor they're going to have for the year. Labor hours would be the activity base. And so we can figure out direct labor, et cetera. So every department will do that. And so I would say, all right, I need this back from you in about a month. So a month later, I would call a meeting for the entire hotel for all of the managers. So, okay, give me all your budgets. And so I'll take all of their department budgets, assemble them in a logical way, and create the master budget. And so that's how it works when you are running a large organization that has multiple departments. You can use that same application for smaller companies as well. But I just wanted to give you that real life example because it's something I did on a regular basis. And once I had compiled all of the budgets, I would then go ahead and put it into the computer system. And if we need to make modifications, we'd make small adjustments here and there. And then we'd lock it down and say, okay, this is it. This is the final budget. And then once the new year started, I would compare the actual sales to the budgeted sales, and we would make minor adjustments, using a factor to adjust budgeting up and down, so that way it comes in close to where it should be. Like, for example, if I drop in sales unexpectedly, I'm not going to allocate that much cash to all these other budgets. So I'll decrease the individual department budgets by that amount. So that way we don't end up in an overspending situation. But that's how it works in real life. So we start with the sales in mind. We start with sales. So everything we do starts with sales. So first thing we do, prepare the sales budget. We do that by understanding the number of units I need to sell to generate the amount of revenue from selling those units. We take the estimated sales price per unit times the estimated number of units we're going to sell. That's how we get the sales budget amount. Here's an example of a company that sells hockey sticks, okay? This company sold 700 hockey sticks at $60 a piece in the past. From October to December, this is what their sales looked like. Okay, so 700 times the $60 gives us an idea of how much total sales we got. But take a look at the amounts below. In October, I sold 1,000 hockey sticks, $60 per stick. That's 60,000. I sold 800 in November, 1,400 in December, for a total of 3,200 hockey sticks for those 3 months for that quarter. At $60 per unit, that's $192,000 total. And that's how you would lay out your sales, okay? Number of units we expect to sell times the sales price gives me the total budgeted amount for sales. We do it for every month, okay? So, and we would do that for 12 months. This example, I'm just showing you 3 months because you could do it by quarter as well. And it's easier to show you 3 months instead of 12. So again, we start with a sales budget. The sales budget drives the production budget. This tells me how many units I need to manufacture during that accounting period. Now, we just saw that we expected to sell 700 hockey sticks. I got to figure out how many hockey sticks do I need to manufacture. The way to figure that out is we take the ending balance hockey sticks. This is how many I expect to end the year with. And plus, how many hockey sticks I expect to sell minus the beginning balance of the number of hockey sticks I had already manufactured. So ending inventory plus expected sales in terms of units minus the finished goods inventory beginning balance. That will tell me the number of hockey sticks I need to make during that accounting period, right? That's the formula. That's the formula we use to figure out how many units we need to manufacture during that accounting period. So important. This part's important. The production budget's not going to show you cost. It's only designed to tell you how many units you need to make. That's what production budget tells us. The reason why it doesn't show you cost is those costs are going to change in the future, right? For example, if we're making hockey sticks, there's a great chance that the price of paint and wood is going to be different a year from now. I don't know what the price is going to be the cost of wood is going to be a year from now. I can get an idea, but I don't know the exact cost. So that's why we express it in terms of units and not in actual cost when it comes to the number of units we need to produce. Now, when I do figure out, I'm sorry. When I do figure out how many units I need to produce, I can then break it down by month. And I do that based on the sales budget per month. Okay. So this is an example of the production budget based on sales. So here's how it works. We got budgeted sales times ratio of future inventory. Ratio of future inventory basically tells me how much inventory I expect to sell through each month. So 90% is what this company normally sells through each month. That will give me. So I take the sales budget based on units, how many units I expect to sell, times the amount of inventory I expect to sell through, will give me the budgeted ending inventory. That budgeting ending inventory becomes the beginning inventory for the next month. That's why you see that red arrow pointing there. So I got my budgeted ending inventory, then I add in the number of units I expect to sell for that month. And that will equal the required units of available production. Then I subtract out the beginning inventory from the previous month. And that will tell me the number of units I need to produce for that month. Does it make sense? You just got to break down the formula. And then we do that for every single month. It looks complex, but when you put it in something like Excel or in QuickBooks or into NetSuite or whatever, it makes it a lot easier. So I tell you what, reality is nobody does this stuff by hand. It's important to know how it works by hand because you need to be in that mindset of this is how it works, right? That's the reason why we go through these kinds of exercises. It shows you how it works, and that part's important. So we talked about the sales budget, which is the number one thing we do. And then I said, well, we got to figure out how many units we need to produce with the production budget, and that's based off of the sales budget. Within the production budget, we need to budget for direct materials, direct labor, and factory overhead. Number of units of materials I need to make the number of units from the production budget. And then, of course, labor hours based off of the production budget and overhead based on the production budget. So we see how it's all connected. So within the direct materials, it shows me how much direct materials I need to purchase in order to meet my production units goal, or budgeted production in terms of units. So, 5 steps to figure it all out. Step 1 is we take the budgeted production in terms of units for that month. Step 2, we multiply that by material requirements per unit. How much material per hockey stick in this example? So, half a pound of wood, 0.5 per hockey stick. Makes sense. Equals materials needed for the production in terms of pounds of wood. Yep. Then I need to add in the budgeted ending inventory, which is in step 3, to equal the total materials required for the month in terms of the amount of pounds I need for the month of October is 690. Minus the beginning inventory from the previous month, which is the ending inventory from the previous month. In this case, 178. Equals 512 pounds of wood I need to purchase. The price per pound of wood during the month of October is $20. So I take the price per pound of wood times the number of pounds I need to purchase to get me a total cost of direct materials for the month of October. In this example, $10,240. I follow that same process for each month. Does it make sense so far? I didn't lose anyone yet, right?
Oh, sure. So far, so good.
Awesome. Thank you, Peter. Okay. And we do that for every month. That's direct materials. Now, of course, you got to talk about direct labor. You have to plan your labor. Just like you're planning the amount of materials you're going to need to purchase, you got to figure out how much labor you're going to use each month. This is very straightforward. We take the number of units we expect to produce, because remember, everything, direct materials, direct labor, factory overhead, it's all driven by the number of units from the production budget. So we take the number of units we expect to produce times the amount of time it takes to produce each unit. In this example, it takes about a quarter of an hour. So what's that, 15 minutes, right? So it takes 15 minutes. A quarter of an hour is 0.25, which is 15 minutes. So number of units times a quarter of an hour, which is 15 minutes, equals 177.5 hours. So in order for me to make 710 hockey sticks, it'll take me 177.5 hours. So number of units you expect to produce times the amount of time it takes to make each unit equals the total direct labor hours you need for that month. So now we got the total hours. Now we got to figure out the cost. So you take the total hours times the labor rate per hour, $12 per hour. So 177.5 times $12 per hour is $2,130 total direct labor cost for the month of October. We apply the same process to every single month. So October, November, December, so forth and so on. So that's direct labor. Very straightforward. Number of units you expect to produce times the amount of time it takes to produce a single unit equals total direct labor hours you need for that month times the hourly rate equals the cost of direct labor for that month. It's good to use a spreadsheet in Excel for this stuff. So we talked about direct materials, direct labor. Now, of course, production also includes factory overhead. And we know that factory overhead includes fixed and variable costs. So, how do we find factory overhead per month? Well, again, since direct materials, direct labor, factory overhead are all driven by the production budget, we start with the number of units we expect to produce for each month times the variable factory overhead rate. Okay, now let me explain variable factory overhead rate. Now, we talked about variable factory overhead rate a few times, I believe. And what this means is it is the amount of factory overhead we apply to each unit of production, to each unit. The amount of factory overhead we apply to each unit. And that is driven by our total factory overhead divided by the activity base to give us the factory overhead rate. That's how we got $2.50 per hockey stick. So we take number of units times variable factory overhead rate to give us the budgeted variable overhead amount. Then I got to add in my fixed rate, my fixed overhead. The fixed overhead is the same every month because, remember, fixed does not change regardless of the level of output. So the fixed overhead amount stays the same. So I take the total amount divided by 12 months, and that gives me my monthly fixed overhead amount. In this example, $1,500. So I take my total variable overhead rate plus my fixed overhead rate equals my total overhead for that month, and I do the same thing each month. Okay, so we talked about the sales budget and how the sales budget drives the production budget. And what drives the production budget are direct materials, direct labor, factory overhead, and all of those have their individual budgets. Now we get a little bit more granular to bring it all together. We can figure out the cost of manufacturing a single unit, in this example, a hockey stick, based on the direct materials budget, direct labor budget, and factory overhead budget. For direct materials, if it takes half a pound of wood, and a pound of wood costs $20, that means my direct materials cost per hockey stick is $10. Half a pound times 20 is 10. Half of 20 is 10. For labor, we said it takes a quarter of an hour to produce one hockey stick. That's 15 minutes. Times $12 per hour, a quarter, 0.25, times $12 per hour, that's $3. So $3 direct labor per hockey stick. My variable overhead rate from factory overhead is predetermined. Remember how we talked about the predetermined overhead rate, also known as a single wide plant wide rate method, whatever. It's predetermined, variable rate. So $2.50 per hockey stick. And then I have the fixed overhead rate. How do you find the fixed overhead rate? Well, there's a couple ways to do it. We take our total fixed factory overhead and we divide that by the number of hockey sticks we expect to produce to give us if we only looked at it from a quarterly perspective, like we did for those 3 months, we can say that it's $1.50 per hockey stick and fixed factory overhead. I add my direct materials plus direct labor plus variable factory overhead plus fixed factory overhead to give me a total cost per unit of $17. Everyone sees how we got there? Makes sense, right? Okay. Now that we figured out our product cost per unit, we can budget our cost of goods sold. We know that it takes $17 per unit to make a single hockey stick. So to find the cost of goods sold, we take the number of hockey sticks we expect to sell for that month, multiply that by the cost per unit, $17. That will equal the budgeted cost of goods sold. And of course, knowing the budgeted cost of goods sold will help me to budget my income statement. Helps me budget my sales, or my expenses. So we talked about the sales budget, the production budget, which includes the budget for direct materials, direct labor, factory overhead. We talked about how to find the total cost of a unit. We talked about budgeting, cost of goods sold. Now, of course, we got to talk about selling and administrative expenses. Selling and administrative expenses estimate the cost of making sales. The cost of making sales includes things like paying our salespeople sales commissions, paying our managers' salaries. These are all related to sales, right? So these are the cost of sales, also known as selling expenses. So I can budget for those based on their sales. If I pay a commission of 10% for total sales, then it's total sales times 10%. That'll be the commissions expense, which is part of selling administrative expenses. And I could also budget out monthly salary for the sales managers. So to find all my selling expenses, I take my budgeted sales amount times 10% equals the sales commissions plus the fixed sales expense of salaries equals total selling expenses. I add those up for, the months across to get my totals. For general and administrative expenses, I can budget these out as well. General administrative expenses include things like the cost of shipping the product. That includes the cost of running the office, taking care of the accounting, etc. So I know how much these are. The general administrative salary is $54,000 a year. Divide that by 12 months, it's $4,500 per month, and I can prepare a budget for general administrative expenses. Very straightforward. So that's selling administrative, selling and general administrative expenses. And then the last, before we get to the cash budget, the second to last budget is called the capital expenditures budget. Capital expenditures are used for the purchase of property, plant, and equipment. PPE, property, plant, and equipment. Oh, sorry. And here's a couple of examples of that. So, capital expenditures budget, it's monies that we set aside for the purchase of property, plant, and equipment. Helps us to expand the business. And last but not least, we need a budget for cash. So important that we know how much cash we expect to have coming into the business and how much cash we expect to come out of the business and for their various purposes. So to do that, we take the beginning cash balance, what's in the bank account, plus the amount of cash we expect to receive from our customers throughout the year, minus the amount of cash we expect to pay for our business expenses throughout the year, equals the preliminary cash balance. If that is a good positive amount and it seems healthy, we can repay loans and do other investing activities. If it's not going to be enough cash for whatever reason, we could do some short-term borrowing to get that cash balance up to a decent amount. But this is the general formula for it. For the cash receipts, that's cash coming in from our customers, it's important that you understand the percentages. How much sales are generated in cash sales, meaning the customer came in, they purchased it, they wrote me a check, or they gave me the credit card, or they gave me actual cash. Those are your cash customers. They paid you that day. That's what a cash customer is. Then we have customers that purchase on credit, meaning I gave them an invoice, they're going to pay me 30 days later. It's important that you know the percentage of customers that come in paying cash or they pay on credit, and you expect to collect on that in the following months. That helps us to create the cash budget for our sales. So it's your sales amount, expected sales amount, minus the amount you expect to receive from your customers on account, meaning they're going to pay us later. That will give us our cash sales customers. Gives us our total cash receipts. So sales minus the amount ending accounts receivable gives us our cash sales plus the collection of last month's receivables equals total cash receipts. So this helps us to budget for our cash coming in from our customers. We also need to budget our cash payments for things like materials. Remember, we're purchasing wood to make hockey sticks, so we need to budget the proper amount of cash for that. To do that, we look at the production budget. Materials purchases, helps us to account for that. So using the general cash budget formula, beginning cash balance plus the amount of cash we expect to receive from our customers minus the amount of cash we expect to pay equals a preliminary cash balance. That's the general formula you need to know. worry too much about that. This shows you what that cash budget looks like from cash coming in from your customers minus all of your cash going out for your various business expenses. And then, of course, any type of loan activity would be separated out. It's just a shortened version of that. Cash coming in from your customers minus cash going out for your expenses equals your preliminary cash budget. And then any loan activity. Now that I have all of my budgets completed, I can apply those budgets to the income statement. The income statement, as you know, includes revenue, which is sales, minus cost of goods sold, equals gross profit, minus selling and administrative expenses, minus other expenses, equals income before taxes, minus income before tax, your income tax expense, equals net income. That's your income statement. We can budget the income statement based off of our sales and based off of our sales, really. You do the same thing for the balance sheet. As you know, your balance sheet includes assets, liabilities, and equity. And we can budget out the balance sheet based off of the cash budget, based off of the materials budget, based off of your, what do you call it, capital expenditure budget, etc. And if you had a service company, you could do a very similar style budget. It's all based on sales. Service companies don't have materials. They don't have, so because they don't have materials, they'll still have direct labor and they'll still have other expenses. We can still budget for all of those things. The difference is, with a service company, we start with sales, budget for direct labor, budget for capital expenditures, budget for selling administrative expenses, and then we could budget for cash. We could also budget based on activities, just as we've done for figuring out factory overhead based off of activity-based costing. We could figure out a budget based on activities rather than a traditional list of items. And this is what this looks. So instead of budgeting for salaries, supplies, depreciation, utilities, et cetera, we could budget based off of the related activities like auditing, tax reporting, financial reporting, cost accounting, etc. In most cases, most businesses use a traditional budget. In real life, most companies use a traditional budget. They don't do activity-based budgeting. Some do, but most don't. A merchandise company, a retailer, they can also follow a very similar process for budgeting. The sales budget helps to drive the purchases budget, which is the inventory that they're purchasing from their vendors. And of course, capital expenditures, cash, selling, and administrative can generate all these budgets for all kinds of companies. For a retailer, merchandise company, we can figure out inventory that we need to purchase by taking the ending balance inventory plus sales we expect to make for the accounting period minus the expected beginning merchandise inventory balance. Just to give you an idea of how that works. It's very, very similar. and we can create a budget for purchases for a merchandise company retailer. Very similar way for the inventory that they're purchasing. Again, it all starts with sales. Sales times inventory from future sales, 90%. This is what we expect to sell through. Gives me ending inventory plus what the amount of units we need to purchase for that month. Equals number of units available for sale minus the beginning inventory balance equals the number of units I need to purchase for the month. Number of units times the cost per unit to purchase it equals the total amount for purchases for that month. And that's how a retail operation works. Again, same method. Okay. That is the end of our conversation on master budgeting and planning. Are there any comments, questions, or concerns before we stop this recording, take a short break, and start the next one? All good?
All good.
Okay, cool. Let me go ahead and stop this recording. Hold on just a sec.